So let's say that you are bullish right now on this market. So let's say you think that the market is going to go up. So what better way for you to put on a bullish trade or a neutral to bullish trade with the bull put spread, right? So if you don't already know, the bull put spread is where you sell an out of the money put option and then you buy a further out of the money put option, right? So at this point of time, you've put on this bull put spread, and then the market starts to go down. So this isn't an ideal situation for you. It's not an ideal scenario for you because you ideally want to see the market immediately go up, right? So what do you do? At this point of time, most likely if you take a look at your trade position, it's losing money because the market is coming down. So let's take a look at the P&L graph, right? So the first thing you want to do is analyze the P&L graph to take a look at, to see whether is there really anything you need to do at this point. So you can see that your short strike is at this point, which is 280, all right? So at this point down here, this is where your short strike is, and where your long strike is for the put option is 270. So what you want to take note of is this red line down here. So this red line is your break-even point. So break-even point basically is the place whereby past this point is where you will start to lose money at expiration, and then above this point at anywhere at expiration you will actually be in profits, right? So let's say for example the market has come down but it has not yet touched your short strike, right, at 280. So at this point of time the market is actually somewhere in this region. So if it's in this region, although, all right, so this is the current market price right now. So although the market has actually dropped and you are actually seeing a loss on your P&L, right, in your trade position, it's actually absolutely fine at this point, right? Because remember, if you are trading credit spreads, right, in this case the bull put spread, this is a neutral to a bullish position. That means to say that even though if the market does go down, and as long as it stays above your break-even point expiration, you will actually still be in profit. So there are two lines for you to take a look at here right now. So let me just clear this drawing so you can see. So if you see that there is this purple line, and then you will see that there is this green line, right? So this purple line basically is your P&L for today, right? So this purple line down here will eventually keep moving, right? It will keep moving as the days go by until it eventually becomes this green line down here. So this green line down here is your P&L at expiration. So between this time, right, from your expiration all the way to today, every single day there will be what is called theta decay, right? So this is time decay whereby the option prices will slowly start to decay over time, and as long as it stays above your break even, you're going to make this full profit. So right now, even though if the market goes all the way down to, let's say, 285, right, 285, you're going to see like you're having some sort of a loss, right? Maybe a couple of $100 loss. But at this point, there's really nothing for you to do. There's no need for you to panic, because as long as it stays here all the way until expiration, or as days go by, you'll see this purple line start to move up, right? It will start to move up until eventually becomes this green line. Now, on the other hand, if you were to take a look on the other side down here, which is past this point down here, this purple line down here will start to shift down, right? It will start to go down until it goes to the green line. So what does this mean, right? So it means that basically as long as, right, we will use the break-even point. So anything above this break-even point, you really do not have to worry, because this purple line will in the end start going up, right? So this is the effect of time decay, which is the benefits of trading a credit spread. So at this point of time, if you were to take a look at the charts, if you see that the market, as long as it's above your break-even point, anywhere above here, then there is absolutely nothing to do, right? So if the market is above the break-even point, do nothing. Now, what if the market starts to go below the break-even point? So this is where you might need to do something, right? Because past the break-even point, we know that this is where we will start to lose money if it stays there at expiration, especially if it goes past this point down here. You know that each day passes, it's no longer going to go up, right? But instead it's going to start to go down. That means it starts to lose even more money as each day passes, right? So what do you do? So the answer is that it depends on whether it's past the 21 days to expiration mark. So there are two reasons why we want to use 21 days to expiration as sort of like a marker, right, to decide whether we're going to do anything or not. And the first reason is that when you pass the 21 days to expiration mark, the chances of getting a sign on your in the money short put increases, right? Remember, if the market starts to go below your short put strike, there is always chance of an early assignment, right? Early assignment means that this buyer of the put option, they will start to exercise their option, and then you will be put 100 shares at $280, right? So that means you will have to fork out a capital of $28,000 to hold on to this position. Ideally, this is something that we do not want, and this is where a lot of people, when they're first starting out to trade options, this is where they kind of a little bit panic, because once they see their short strike being breached, one of the biggest fear is getting assigned. So if you want to reduce your chances of getting assigned, then you want to see whether it's past the 21 days to expiration mark, because whether you get assigned or not on this put option really comes down to how much extrinsic value left there is in this option, right? So the greater the extrinsic value, the lesser chance there is to get assigned, right? Because it doesn't really make sense for you to assign as the put option buyer, because if you were to exercise the option, then you will be giving up your extrinsic value, right? That makes no sense. If you want to profit on this put option as the put buyer, you can just simply sell off your put option. So when is the time where there is lesser extrinsic value, right? So the time where there's lesser extrinsic value is when it passes the 21 days to expiration mark, where it's getting close to expiration, right? As it goes closer to expiration, the theta decay starts to become even higher. So that's when you start to rapidly decay whatever value there is in the option. So this is where the chances of you getting assigned on your in the money short put gets higher. Now, the second reason why you want to take a look at 21 days to expiration is because there's already been studies done, the research done by the Tasty Trade team, that if you were to manage your trades, right, if you were to take off your trades at the 21 days to expiration mark, you actually see that you reduce your average loss significantly, right? So you can see that based on a $5 and $10 white put spread, right, if you hold to expiration, you can see that it's a few $100s, right? But if you were to manage it at 21 days, right, you close your trade out early, your loss has been reduced dramatically. And at the same time, you have higher return compared if you were to hold it all the way to expiration. So these are the two reasons why we want to use 21 days as a marker. So based on this 21 days to expiration, this is where we're going to have an idea of whether we're going to do anything or not. So with this in mind, if the market is below the break-even point and it's still above 21 days to expiration, guess what? You do nothing, because there is still time for the market to eventually rebound, right? So the beauty about the credit spread is that you actually already sort of have your maximum loss in place, right? Because you have already bought this put option down here. So you do not really actually have to worry, because you already have defined your risk. You already know what's the maximum loss that you could lose. So the market can go all the way to zero for all it cares. It doesn't have to bother you, because you already have your maximum loss in place, which is at the 270 put mark, right? So you cannot lose anything more than the width of this put spread, minus the credit, of course. So when there's still above 21 days to go, there's always chance for the market to come back, right? You let theta decay work in your favor. You continue to hold on to this trade, even though it can go all the way down, it can eventually come back up. And because there is still a lot of days left to expiration, the chances of you getting assigned is very, very low. Now, what if there's less than 21 days to expiration? So there are two things that you can do. Well, the first of which is to simply just take a loss. So if you were to take a look at the P&L graph down here, so anything that is below the break-even point expiration, we already know we're going to lose money. But if it's below this point down here, if you can see this point down here, the longer that you hold it, each day that passes, this purple line will start to accelerate to this green line down here, right? This is where it will be at expiration. So each day as you hold, you're going to start to lose even more and more. So that is why for me, generally, as long as it's past the 21 days to expiration mark and it's below my break-even point, I generally just take a loss. I have many different trades on, so I do not want to try and salvage every single trade, right? Just remember, when you put on this trade, there's already a 78.43%, right? Around 70+% if you're going around the 25 delta mark, right? If you were to put on this trade. So there is always a chance that you can lose. So there's no need to always salvage every single trade. So if this trade is a loser, you can always put on another one. So you might be saying, you know, I do want to try and hold it, because if you hold it, you might go back past to this point, and then at this point on, right, you will start to make more money as each day passes. Now, definitely this is an option that you can do, but what if it further goes down, right? Then if it goes further down, then it's going to be much more difficult for you to eventually recoup back the losses, because it has to move a greater distance back up, right? So at the same time, when you're past the 21 days to expiration mark, don't forget you are now below your short strike. So as it goes closer and closer to the expiration time, right, the expiration date, your extrinsic value will get lesser, and it gets even lesser as the market moves further deeper in the money, right? As it goes all the way down, it goes deeper in the money. That's where your extrinsic value will start to shrink as well. On top of that, your extrinsic value is already starting to lose even more because of theta decay. And that's where you're going to start to have a very high chance of getting assigned, and then you'll be put the 100 shares, which I'm pretty sure that is not a situation which you want to get into. So that's the first thing that you can do, which is simply just to take a loss. Now, the other thing is that if you don't want to take a loss and you still have a bullish view, right, you still think the market can possibly rebound, then you can roll it, right? You can roll it if you can get a credit. Now, rolling credit spreads is very different from rolling just a naked short option. Let's say, for example, a naked short put. If you roll a short put, chances are that you can always roll for a credit. But when it comes to a credit spread, it is not always that you can get a credit, right? It really depends on whether the price is closer to the short put strike or the long put strike. If it's closer to the short put strike, then yes, you can most likely roll for a credit. But if it's closer to the long put strike, then chances are that it will be a debit. Then at that point of time, then it wouldn't really make sense to roll your credit spread. So the process of rolling a credit spread is actually pretty simple. What it's actually doing is that you are closing out this short put spread, and then you are selling another put spread, right? So in actual fact, what you're doing is that you are closing out your current put spread for a loss, and then you are selling another put spread with a credit that is more than the loss, so this way you get overall credit. So maybe when you close out this put spread, maybe you have to pay out $5 for this, and then when you sell the put spread again at a later expiration date, so maybe let's say there's 21 days to expiration left, so what you want to do is you want to roll to the closest expiration date that is around 45 days to somewhere around 60 days to expiration date, and then you will be selling this put spread maybe for $5 and say 50 cents, right? Maybe $5.50. So this way you get a credit of 50 cents. So when you're doing this roll, what you're essentially also doing is lowering the maximum loss on this spread, right? So maybe your maximum loss for this spread could be maybe say $8, but now that you receive 50 cents for this credit, which means to say your maximum loss could now be just around $7.50. And if you just keep rolling this each time, whenever you get a credit, you're just slowly reducing the maximum loss until eventually the market comes back up. So this is something that you can do if you want to roll your credit spread rather than just take a loss. Now, the other question you might have is, you know, what if the market actually comes down, but it's still above the put strike, right? And then at 21 days, it's still above the put strike, but then I'm still at a loss, right? If you were to look at your trade position, you will see that this could be a loss. So what do? Do you actually take out for a loss? So for this, it really comes to you, right? Remember, if you were to take a look at the P&L graph, anything that is above the break-even point, we are still in a profit, right? Technically, we are still in a profit above this break-even point as long as it stays there by expiration point. So if it's above this point, let's say for example the market is down here, you may see that you're still in a loss, right? You may still see that you're currently in a loss, but then it's not necessarily a loss if it stays there all the way to expiration. So at this point, you can either just choose to hold on to this position all the way to the expiration date, or at this point, you can just roll it, right? You could just roll it and get even more credit, right? There's a chance that if you roll it when it's above the strike, you can get quite a bit of credit. So this way you are prolonging the trade, and at the same time you give it chance for the market to eventually go back up, and then you could profit on this position as well. So it really comes down to you at this point. Okay, so this is for the put spread. Now, what about for the call spread? Well, the call spread is pretty much just the opposite, right? So if you are bearish, let's say you're bearish on the trade, you put on a call spread. So if the market is below the break even, basically you do nothing, right? Similarly, so the break even will be above this time. And if the market is above the break even, right, in this case, then again, we take a look at the 21 days to expiration point. So if it's more than 21 days to expiration, you do nothing. And if it's less than 21 days to expiration, well, you either take a loss or roll if you can get a credit. Simple as that. Now you might be asking, but Davis, what about turning it into another trade, right? Something more advanced, more complex. So for example, you might turn the short put spread into a short put, right? So for example, you have the short put spread down here, right? So you have the short put and then you have the long put. So some people, what they do is that when the market actually goes down, right, they see these two as a separate trade now, they split them up because you will be losing money on this short put position, but you will actually be making money on this long put position. So what they do is that they sell off this long put position, so they make money on this long put, and then for this short put, what they do is that they roll it down, right? They roll it down. So by rolling down, what you do is you get additional credit as well, and at the same time you reduce the break-even point of your new trade right now, which is a short put, and then you give some time for the market to rebound, right, if you're still bullish on this trade. So should you actually do this or not? So my take is that I generally like to just enter the trade and exit the trade as the original trade. Right? If I entered it as a put spread, I want to exit it as a put spread. If I enter it as a call spread, right, a bear call spread, then I want to exit it as a bear call spread. Because the reason is that when you turn it into the short put, you have totally changed your risk profile. So let's say, for example, if you receive, say, $2 for this credit spread, right, and then the width is $10. So the maximum loss is pretty much basically the width minus off the credit, right, which is $2. So your maximum loss will be $8, right? $8 would be your maximum risk, which is $800 per credit spread that you put on, per put spread that you put on. Now, once you have changed this into a short put, you have totally changed the dynamic of this trade, because now no longer is your maximum risk $800. Your maximum risk is all the way to zero, because at this point of time, remember, you have turned it into a short put. So let's say you have rolled the short put down from 280 to 270. So 270 is now your short put at, right? So now you no longer have any protection below. You have no protection below, then in the event whereby the market crash, then you can lose much more than this $800 which you initially had it on, right? The initial risk when you put it on. So that is why I do not really like to put it on. Can it work? Definitely can work if you are right on the trade, if it goes up. But if it goes down, then you're going to lose much more than what you initially allocated to the trade in the first place, right? So that's my take on converting it to a short put. Now, what about turning it into a butterfly or an iron condor? So by turning it into the butterfly or iron condor, so it's slightly different from short put, because with the short put, you have turned a defined risk kind of trade into an undefined risk. But by turning it into the butterfly or iron condor, what you're doing is that you're still sticking to a defined risk strategy, right? You're changing it to a defined risk strategy still, where there's a maximum loss, but then now you've changed a little bit of the dynamic. So in this case, maybe for example, if the market goes up, then you say, hey, I want to change it to an iron condor. So you sell a put option here, and then you buy a put option here. So -1 and then +1. So down here you have an iron condor. So first of all, when you do it this way, when you sell a put spread, you will receive a credit as well. So this way you actually reduce your maximum loss, right? So if previously your maximum loss was $800, let's say your previous trade, right, your call spread, let's say you put on this call spread down here, the maximum loss is $800. Now by putting on this spread, let's say you receive $1 in terms of credit, right? So $1 will basically be $100. So you will minus off $100 from your maximum loss. So now you have turned this trade into a maximum $700 loss because you have received credit for this, and the market can only be at one side at expiration, right? So this too has to be the same expiration date, by the way. You want to keep it at the same expiration date so there's no messing around with the different kind of duration and timings, right? So when you do it this way, you reduce your maximum loss. But the problem with this strategy is that you actually also have reduced your probability of profit, right? When you put on this trade, your probability of profit should be maybe around 70 odd percent, right? Let's say 75% if you put on roughly around a 25 delta for the short strike. So your probability of profit will be around 75%. But because you have put on this put spread, suddenly you have totally changed the dynamic of this trade, and then now the probability of profit is going to drop. It's definitely going to drop, and it's probably less than 50% because now you have really tightened up this space where it can be in profit, and in the case where the market goes down, it doesn't really have that much room right now, right? It doesn't have that much room for you to be in profit, and you probably have to hold on to this trade for a longer time because now you have the friction of the short put spread, because even though you're making money on the call spread as the market comes down, you're losing money on the short put spread. So that is why I don't really like the idea of turning it into a butterfly or iron condor, because once you do it, you're pretty much like, you're throwing in the towel, right? You're pretty much saying that, I don't think I can really win. I just don't want to lose that much. Because if you think about it, if you were to place this iron condor at the start, you're able to get it at a much wider length, right? You will get a much wider profit zone. So let's say, for example, you have the 280 and the 270 put spread. So this makes the iron condor. So the iron condor previously, you may also, let's say, for example, you get $1 or maybe $2 for this, and then you get it at a much lower strike price, right? Making your iron condor profit zone much wider. But because the market has gone up and then you sell the put spread above, what you have done is you actually gotten the same credit, but now you got it at a higher strike price. So in a sense, I feel this is a little bit of a disadvantage, because you could have gotten a wider profit zone, whereby if the market did come down with the original iron condor, if you had put it on this way, you would have been in a profit. But right now, you have to settle for a smaller loss. So this is my take on turning into a butterfly and iron condor. So I don't really do this too, but I know some people do, and whether you want to do it or not really comes down to your own discretion. But I do think that it is much better if you just left it as the original trade and then just either roll it by itself if you can get a credit, or just cut loss and then just wait for another opportunity again, right? So remember, there's no need for you to win every single trade, right? The probability of profit is already there. You have a 75% probability of profit. Let's say you put on this trade for 75% probability of profit, then guess what? You will win 75% of the time. And that also means that you have a chance to lose 25% of the time, right? So you will have winners and losers. You cannot always try and get a winner out of every single trade. Right? The best thing for you to do is just keep on putting the trades, so over time the probability will play out. Just like if you were to flip a coin, say just 5 times, it's easy for you to get 4 heads and just 1 tail, right? It's very possible. So let's say each time a heads is a loss, so you could get 4 losses and then 1 win just by flipping the coins 5 times. But if you were to flip the coin 500 times, 1,000 times, then guess what? It's most likely going to be around 50%. So it's the same for your trading, right? The beauty about options is that you already know your probability upfront. You have the rough estimate of your win rate upfront already when you put on the trades. So all you have to do is just let the probability play out as you put on more trades. So what really matters is to position size your trades properly according to your capital allocation and manage your risk well. That means to say you do not put such a big position on for your trading account size, right? So if, for example, your trading account size say is $10,000, then you do not want to risk more than $500 to $700 per trade, right? If you were to put on one credit spread and it's going to risk say $5,000, then that is way too big. So that is where you'll start to panic as the trade goes against you. So remember, keep your size small and then just let the probability play out in the end. So this is a skewed iron condor. So basically a skewed iron condor is whereby you have very different size width on each side. So as you can see, for the put side, it is slightly bigger than on the call side because of the skew, right? So for index ETFs such as the spiders, the QQQs, IWMs, they have put skew. So basically what it means is that your options on the put side will be slightly more expensive, and that's only because the perceived risk by the market is to the downside, right? So at the same time, when you put on this skewed iron condor, you'll notice that for the put side, it's always going to be wider. So what this iron condor is basically I have 16 deltas on both sides for the short options, and for the long options, right, they are both 5 deltas, right? So you can go ahead to your option chain and you notice that for the 16 deltas as well as for the 5 deltas, they are pretty much further away from each other in terms of distance from the market for the put side and the call side, right? So for example, the put side, you'll notice that it might be maybe $20-30 wide, but whereas on the call side, it might be only maybe $20 or $25 wide. All right, so this is the difference between a normal iron condor and a skewed iron condor. So if you're just starting out, I don't want you to be too concerned or too worried about this. You might just want to go with the standard width, which is maybe like $10 wide on each side. All right, but in terms of how you manage this losing iron condors, they are the same. All right, they're pretty much the same. All right, so in this case, you can see that this is an iron condor. So the iron condor is very different compared to the credit spreads, because if you were to put on just a bull put spread, let's say for example just the bull put spread, and the market was to trade up from this point in time, you're going to see that your put spread is going to be very profitable, right? You're going to be in profit immediately, no matter how far it goes above. Similarly with the credit spread for the call side, the bear call spread, if the market goes down, then you're going to see a profit on the call spread. All right, but for the iron condor, because you have on both sides, right, the combination of both the bear call and the bull put, it's very easy for you to see a loss at any point in time during your trade, right? At any time when you're holding on to the iron condor for days or weeks, right? It's quite easy for you to see a loss because you have this friction on both sides. So if the market is to go up, all right, even just a little bit, maybe somewhere down here, you're going to see that your put spread is going to be in a profit, but your call spread is going to be in a loss. Similarly, if the market just trades down a little bit, you're going to see a profit on your call side, but then your put spread is going to be in a loss. So overall, it will come down to a loss. All right, so you do not want to panic when that happens, because it is very common, it's natural. The way you make money on your iron condor is as time passes, then your profit will start to show. So for you to really understand how an iron condor works or behave, you want to take a look at the risk profile. Right, so this is the risk profile of the iron condor, right? A normal width iron condor with $10 wide on both sides is also pretty similar. So what you will notice is that there are two lines, right? So you'll see the green line. So the green line is basically the risk profile, or rather the P&L graph for it when it hits expiration, right? When it's at expiration. Whereas for the purple line, it's the current day, right? So when you put it on, you'll see this purple line, and over time, this purple line will conform to this green color line down here. Basically, it will change. So from this point on, you can see that the purple line, right, over time, as it goes closer to expiration, it will go up closer to this green line, whereas when it goes past this point, it will start to go down to conform to this green line down here. Similarly down here as well. So you can see that as long as the market just moves, even though it moves, you know, it doesn't really have that much of a big move to test your short strikes, right, on both sides, you can see that it can be in a loss. All right, you can see that at this point of time, let's say it goes to this point down here, let's say it comes down here, right? Let's say the market made a big move, it comes down here, you will see that it's in a loss. Okay, but it is still well within the profit zone of the iron condor, because the iron condor profit zone, as you can see, is from this point all the way to here, right? So this is actually past your short strike. So your short strikes are at this point. This is where your short strike is. This is where the short put, this is where the short call is, and then your long call, sorry, your long call is here, and your long put will be down here. So what you want to take note of down here is where your break-even point is. So let me just remove all these drawings. So the point you really want to take note is this break-even point. So that means past this point, at expiration is where you will start to lose money. Anywhere within there, as long as it stays within this break-even point, this two break-even point, you're going to be in profit at expiration. So with this in mind, what you want to do is take note of the break-even point. So you can see the break-even point on both sides. They'll show exactly what is the amount, so you can actually put this on your chart. You can put the points down there, something like this, right? So what you want to see is that if the market is still trading well within the break-even point, guess what? There is nothing to do, right? So if the market is inside the break-even point, do nothing, right? Do not be overactive where you try and manage it, where you try to shift this in, or you try to close out one side and hopefully, you know, the other side rebounds back. Ideally, if you put on as an iron condor, you want to exit as an iron condor as well, right? I'm not a big proponent of shifting this here and there if it doesn't actually go past your break-even point. Because remember, you want time to be on your side. Time is on your side. You have theta decay, right? So iron condor is a theta decay kind of strategy where you have time decay working on your side. So as time passes, as long as it's within this zone, slowly this will go up. You're going to make money on this, all right? So with an iron condor, you want to give it time to really nurture, mature, and finally give you the profits which you want if it's inside the profit zone. Now, what if the market is outside of the break-even? What if it really moves it has such a big move that it goes past your break-even point? Well, at this point, then this is something where you might need to do something, and it depends on whether it's past the 21 days to expiration mark. Alright, so 21 days to expiration mark is a focal point on where you start to manage your options. And the reason why you want to manage at 21 days to expiration, well, one of the reason is because when you go past 21 days to expiration mark and your options, right, your short strike, your short call and your short put, when they are both in the money, this is where the chances of you getting assigned increases, right? If the market goes past this short put, that's less than 21 days, then your extrinsic value is decreasing rapidly by the day, right? So what determines whether your short strikes, whether your short call or your short put is going to be exercised by the buyer of this option comes down to how much extrinsic value there is left in this option. Well, basically the rule of thumb is that when there is very little extrinsic value left, then there's a very high chance for you to get exercised. And extrinsic value also got to do with how deep in the money the option is. That means if the option is really deep in the money, then there's going to be a lot of intrinsic value but very little extrinsic value. So that's when you're going to have a high chance, or rather an increased chance of getting assigned. And also as it gets closer and closer to expiration date, remember at expiration all options lose their extrinsic value, right? Extrinsic value goes to zero. So as you get closer and closer to the expiration date, you're also going to lose a lot of your extrinsic value, because that's when theta decay really rapidly increases to decay the value of the options, right? So when you're past 21 days to expiration mark, this is where your chances of getting assigned is going to be higher. But if it is above the 21 days to expiration mark, then guess what? You're going to still have a reasonable amount of extrinsic value because there's still quite a bit of time, right? So when there's quite a bit of time, usually the buyers of these two options, they won't really want to exercise the option, right? Because they will be losing the extrinsic value. They'll be giving up the extrinsic value if they exercise, right? The better way for them to actually manage it would be to just sell off the option and to reap the profits, right, with the extrinsic value. So it really makes no sense for them to really exercise it early if the extrinsic value is still pretty high. So a safe margin, or rather a good margin of safety where you know there's a lesser chance of getting assigned, is when there's more than 21 days to expiration. Now, the other reason why we want to manage at 21 days to expiration is because there has been studies already done, right, in-depth studies and research, that when you manage your trades, especially for, in this case, Iron Condor, when you manage it at 21 days to expiration, you will find that your results are actually better. Right, so if you can see, this is a study done by the Tasty Trade team. They have done really in-depth research into this. So for the Iron Condor, in this case, a 20 Delta $5 white Iron Condor, you can see that if you hold it to expiration, your win rate is only 66%. But if you were to close it out or manage it at 21 days to expiration, then your win rate is 72%. It's much higher. right? At the same time, your daily P&L is higher as well. You can see this is 60 cents compared to 34 cents. So there is definitely much more benefit when you manage it at 21 days to expiration, and this is generally the rule of thumb, which is what we want to do when you are selling options, when you're selling premium. 21 days to expiration is the point where you want to start to do something. All right, so the other thing which you want to see is that you can see that the performance at 21 days to expiration when you manage it is significantly much better than if you were to hold to expiration, right? You can see that as time goes past, right, you trade past around from 2011 all the way to 2018 and so on, 2020, you can see that the performance of the 21 days expiration really outshines if you were to hold it to just to expiration, right? So that is the reason why I generally manage my options at 21 days to expiration. All right, so what do you do if it's outside the break even at 21 days, right? When there's still more than 21 days to expiration. Basically, when there's more than 21 days to expiration, you pretty much just do nothing, right? Just let the trade work out, let theta decay work in your favor, and you never know, right? The market can always come back up. If you were to manage too early, then guess what? You have removed the chances of you being profitable because you didn't give enough time for the trade to work out. Don't forget, when you are putting on an iron condor, you've already got the long option in place, right? The long option basically already limits your maximum risk. So if the market goes to zero or it shoots all the way to the moon, you don't have to worry because you already have the maximum loss defined in place. You already know what's the worst result that can happen. And when you put on this trade in the first place, this maximum risk should be based on the capital allocation that you are comfortable with, right? That you are certain that, you know, even though if you hit the max loss, it's not going to destroy your account, right? So that's why it has to be a small percentage of your account, okay? So what do you do if there's less than 21 days left, right? If there's less than 21 days left and your break-even points have been breached, well, the first thing that you can do, the first option, the very simple option to do is to simply just take a loss, right? This is actually my default option and the one that I like best because for me personally, I have many trades on, right? I can be managing up to 20 trades at one time on the same product, on the same index ETF. So for me to manage every single one of them is going to get so confusing, right? You want me to manage this by, you know, closing this or turning this to the different trade or to roll this in and out. It's too confusing for me, right? I'd rather just take my loss. So one thing that you want to understand is that you will have losses, right? So if you were to take a look at the P&L graph, you'll notice that you have a pretty high win rate, right? This is about 85%. But this doesn't mean you're going to win all the time, right? There are chances that you're still going to lose, right? There's 10% chance you're going to lose on the upside, and there's about 5 to 6% chance you're going to lose on the downside, right? But I know that I'm going to win the majority of the time, so there's no need for me to make sure that every single trade turns out to be a winner. If that trade at 21 days is a loss, then guess what? I'm just going to close it out, take the loss, put on another trade again. So that's the first option that you can take, the very simple one. Now, the next option you can take is if you are wanting to fight it back, right? That means you do not want to take a loss. There's nothing wrong with that. By the way, if you think that the market may come back or you want to hold on to it in case the market comes back, you can as well. So what you can do is to roll out the whole iron condor out if you can get a credit, right? So for example, let's say the market trades somewhere around here and it's still inside your strikes. So if it's still inside your strikes in this case, but it's already past 21 days, right? In this case, you can actually still hold on to the trade because if you were to take a look at the P&L graph again, all right, let's just remove all this drawing. Let's say it's somewhere down here, right, past 21 days to expiration. Maybe there's 20 days to expiration left. So if you were to hold on to this all the way to expiration, and given the fact we assume that the market actually stays here at expiration, guess what? You're still going to slowly profit because over time this purple line is going to go up to match this green color line. So you're still well within the profit zone, right? But the thing that you want to understand as well is that this line will start to get steeper as well. It starts to get steeper. As you can see, this line down here is pretty steep compared to this purple line. So as it gets steeper, what it also means is that as long as the market moves against you, that means let's say it continues to move down, then guess what? The loss you're going to take is going to be much faster as well, because you're going to have an accelerated loss to the downside. But of course, you also have an accelerated gain to the upside because the curve is steeper as well. So at this point of time, you are quite subjected to the underlying movement, right? You're much more sensitive. So that's why it's kind of like a big risk, big reward kind of thing at this point, because you can make more if the market moves towards the center of the iron condor, but if it moves away, you're going to lose more as well. So this really comes down to your decision, right? It's your discretion. If you want to hold on to it, nothing wrong with that as well. The other alternative is to just roll the whole iron condor out, right? So chances are that if the price is still within the iron condor at 21 days, then guess what? You can roll this whole iron condor out for a credit, right? Chances are that you'll be able to get a credit. If it turns out to be a debit, then you do not want to roll, of course, because ideally we do not want to roll for a debit, we want to roll for a credit. When you roll for a credit, you're essentially also giving time for the trade to work out. At the same time, you're reducing the max loss as well. Although it's not going to be a huge credit, a little bit of credit can help, right? So what I also want to show you that at 21 days to expiration, this is how the graph actually looks like, right? So you can see that the purple line starts to go up already. Slowly it's going up towards the green line, slowly going to turn into the green line. But there are still areas within this profit zone from here to here that you could still be in a loss, right? For example, at this point down here or at this point. So at 21 days to expiration, you can see that you are in a loss, although you are still in the profit zone. So again, at this point in time, roll out the whole iron condor if you want to put on more trades. So this way, when you roll out the iron condor, you're also smoothing out this purple line again. So this purple line kind of resets back, right? It resets back to this, so you're not as sensitive to direction, and you're just letting time decay work in your favor. But if you don't roll it out, then you could just hold it all the way to expiration or close to expiration. When it comes back in, then you can take profit as well. So this is just some ideas for you in case you plan to roll out the whole iron condor. Now, the third option you can do is to simply close out the untested side and then roll out the tested side if you can get a credit. So let's say, for example, the market goes down to test the put side. So let's say, for example, the market is at this point, at the past the 21 days to expiration. So at this point, your call spread is close to a maximum profit, right? Maybe if you put on for, let's say if you put it on for $1, you might be seeing 90 cents in profit. That means it's worth 10 cents right now. So what you could do is you can just close out this whole call spread and then manage this as a single put spread by itself. So now you're managing as a bull put spread. So how you manage this bull put spread is that if you're able to get a credit, you could roll it out. If you can't get a credit, then what you can do is you can actually hold it. Hopefully the market does rebound back up. If it does rebound back up, you can either close out for a profit, or you could choose to roll it out again, right? So in this way, what you're doing is you're pretty much splitting up the trade, right? You're taking a profit on this so that you just live with the put spread, because maybe you're still bullish on it. You think it's time for it to rebound because the market has been pretty oversold at this point. So if you did not close out this call spread, if the market goes out, then you're going to lose some of the profits that you have already gotten on this call side. So again, we don't know which is the best move, right? You never know which is the best move until the market moves, because if you close out this and the market goes further down, then guess what? It's better for you to hold on with this to at least get the remaining 10 cents to kind of like cushion the losses on this side. But if the market goes back up, then closing this out would actually be a good choice or a good method, because you have already gotten most of the profit out of this, and then now your put spread is going to be in a profit. So that is the third option that you can take. Now, the last option would be to roll the whole iron condor out and in the untested side. All right, so sounds complicating, but let me just explain it to you. So let's say, for example, the market goes down to test the put side, right? So the market for your put side is in the money past the break-even point. So what you want to do first of all is to close out this call spread, and then this is what you call rolling in and out. All right, so basically what you're doing is that you are shifting your iron condor closer to where the market is, right? When you bring it down and then you roll it out, you get credit, right? Because when you are closer to the market, the credit which you have, the premium will always be higher. So what you're doing is that you are trying to get more credit and then at the same time also reduce the maximum loss. So when you do this, you can actually do this as a single roll, right? What you want to do is you're rolling out to a further expiration date and rolling down towards closer to the current price. So you're going to get a credit on this. At the same time, you can roll out your put spread as well. So chances are that if your put spread is really in the money, then it will be a debit, right? But you want to roll both out because you want to have both at the same expiration date. So ideally what you're doing is that hopefully the credit which you get for this is much more than the debit you're paying to roll this put spread out. So let's say, for example, if you're paying, let's say you're paying 50 cents to roll out this put spread, but then by rolling out and rolling down your call spread, you're getting a credit of, let's say, maybe $1.20, then guess what? You're going to be in a net credit at the end of the day. You're going to have a net credit of 70 cents for doing this roll. So I know of some people who like to do this because when you do this, you're reducing your risk. You're also giving the trade to work out as well in case you're right. But I generally do not like this method the most out of the four, right? I'm not a big proponent of this method because although you have increased the chances, right, that the market may come back up and you reduce your loss as well, but the thing is that you have reduced your probability of profit. You see, when you first start out your iron condor, you have a pretty huge zone, right? So this is pretty much around a 60% win rate or so, right? So you have put on a roughly 60% win rate, but then when you start to roll it out and down the call side, suddenly now you are left with a very small profit zone. So even though if the market goes up, guess what? You're still going to be somewhat in a loss because you have reset the iron condor, and now your iron condor needs time to work out, need time to mature. So you have such a small profit zone. So if the market just goes a little bit higher again, guess what? You're going to be in a loss again. And this is where it gets, kind of tricky. What are you going to do then? So although there are some people that actually does this is not something that I like, but you can definitely reduce the loss, the maximum loss on your trade compared to when you first started out, right? So let's say if you put on a $10 white iron condor, and let's say you receive, let's say, $2.50 in terms of credit. So that leaves you with a maximum loss of $7.50 for the iron condor, right? The maximum loss. But if you were to roll all this, you get 70 cents in terms of credit, or let's say, for example, you get $1.50 in terms of credit, right? Then guess what? Then you're going to reduce this maximum loss from $7.50 to $6, right? If you get $1.50 in credit. So now your maximum loss is only $6 instead of $7.50, and you still can get a profit if the market really stays within this zone close to expiration, right? So these are the four options that you can take. My favorite one is this, take loss, and then the rest really comes down to up to you. You can roll out the whole iron condor if you can get a credit, or you can close out the untested side, and then the tested side you can manage it as though as a single credit spread, which I also talked about this in my previous video, which is how to manage losing credit spread. You can go and watch that video. Or if you want to be even more defensive, this is pretty defensive. What you're doing is you're rolling the whole iron condor out and then rolling in and out the untested side, so you get more credit to eventually reduce the maximum loss. All right, guys, so I hope this video has been very helpful, gives you a little bit more idea into how you can manage losing iron condor. So the biggest takeaway I want to give you for managing iron condors is that you do not need to make sure that every single trade you put on is going to be profitable, right? There will always be times where you have to take a loss, right? When you take a loss, just take it. Remember, the probability is always on your side as an option seller. You just want to put it there consistently, put it on consistently, and over time, let the edge play out, right? But on the other hand, you want to manage it, it's fine as well, so you can manage according to this. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So let's say, for example, you decide to sell a short put because you think maybe the market might go up. So right now you have a short put position on, So for this example, I use a short put strike of around 382. So let's say, for example, the market did not behave as you have expected, right? It did not go up. Instead, it comes down, right? So at this point, most likely you will see a loss on your short put position. So what do? Is there anything to do at all? So it really comes down to exactly where the market is, right? So the first thing we want to do is to see the risk profile of our short put, right? We want to take a look at the P&L graph, which you can actually see from your broker like Thinkorswim or even the Tasty Trade platform. So this is the short put risk profile. So the first thing you want to do is to identify where your short put strike is, and that is at this point down here, right? So at this point down here, you can see it goes all the way down here. This is where your short put strike is, but you notice that your profit and loss, or rather your loss, does not happen until after this point down here. So you can see this red line down here. So this is actually your break-even point. So that means to say that even though the price may go past this short strike of yours, you are still not necessarily in a loss if it stays above the break-even by expiration. So as long as it's above this break-even point by expiration, you will still be in a profit. So the only time that you will lose at expiration is only past your break-even point. So this is what we want to take note of. That is your break-even point. Now you will notice that there are two lines down here on this P&L graph. You notice there is the purple line and then there is the green line, right? So if you are new to reading this P&L graph, basically the green line is the P&L for your short put at expiration, whereas for the purple line is basically the P&L graph for today, right? So every day it will change, right? So as days pass, this purple line will slowly go up to fit to this green line down here. So what it means is that as the position matures, right, as days pass, this purple line will slowly start to go up in a profit. So that means to say, even though if today, if the market goes all the way down, let's say to around 385, which is somewhere down here, what you will see on the P&L of your position is that you will be losing money, right? You'll be losing almost close to $500. But that doesn't mean that you need to do anything because you are still in the profit zone. So the profit zone is basically anywhere from this break-even point all the way above. So what you want to do is take note of this break-even point and then you can plot it on the chart. So this way you know if it reaches past that point, past expiration, then you will not be in a loss, but everything else above it, you will be in a profit. So that means if the market is above the break-even or the strike price, right, it's up to you to decide which is the point which you want to use. If you're slightly more defensive, then you want to use the put strike point, right? So in this case, whereby if the market goes past this strike, then you will do something, but if it's above this strike, you do nothing. Or if you want to give the trade more room to move, then you can use the break-even point as a place whereby if the market goes below the break-even point, then you will do something, right? But if it stays above the break-even point, even though it is past the strike price, then basically you can just do nothing, right? Because you are still in the profit zone. So there's really nothing for you to worry or panic about, because if the market just stays there until expiration date, you would still be profitable. Now, what if the market actually goes below the break-even or the strike price? Well, if it does go below the break-even or the strike price, then this is where you may need to do something. Okay, so the first thing we need to understand about short put is that this is an undefined risk. So when it is undefined, it means to say that there is a chance for you to lose much more than the margin you're going to put up, right? The margin you're going to put up, the buying power effect that you're going to put up, right? So in this case, you can see this is the short put position. For putting up this position on the SPY, you would have to put up roughly $6,000 to $7,000 in terms of buying power reduction. And this is being held by your broker, okay? So you will notice the other number is this number, which is the max loss. Right, so the max loss, as you can see, is $37,614, which means to say that the stock essentially goes to zero. Now, in this case, it's very highly unlikely because it's an index ETF, but if you were trading individual stocks, then there is still that risk, right? There's the risk of individual stocks. Let's say, for example, you happen to get into SVB, Silicon Valley Bank, before it went bankrupt, then you would be pretty much facing this big of a loss. All right, not this big, but you'll be facing the max loss on that trade, right, if you put it on. So when it comes to trading short puts, the difference between this and vertical spreads, which is like the bull put spread, is that the bull put spread has sort of like an embedded stop loss in place, because the lower part, let's say for example you were to sell the put option here and then you were to buy another put option there, this makes the bull put spread. You really have the inherent stop loss in place in a sense, right? Because the market can go all the way to zero, but you already have your maximum loss already defined in place, right? So in this case, you don't lose more than the spread width, right, in this case. But with the short put, you can lose a lot more than what you actually put up in terms of the buying power effect. So to prevent you from losing this max loss, what you need to do is that whenever the position reaches this amount, right, you start to lose the buying power requirement which you put up for the trade, the initial buying power requirement, then you want to cut loss, right? This is the most important part, because we do not want your loss to go bigger than this. Because remember, when you are putting on any of the trades, you need to have your capital allocated, right? So the buying power should be a maximum of 5 to 7% of your capital. That means to say, if your trading account is $100,000, that means you can only trade one contract of this short put. So in the event whereby the market really crashes and then you actually hit this loss, right, then this is where you need to get out of the position. Get out of the position to prevent it from growing even bigger. So the most that you will lose is actually only 5 to 7%. So this is very important, because you do not want to let any single trade blow up your account, right? If you hear a lot of stories that people say they trade short put and they blow up their account, it's because they do not have the proper risk management and they did not allocate their capital properly. So as long as you keep it to this percentage, right, and then you cut loss when it hits the maximum buying power effect, this number down here, then you know that it will not be a huge substantial loss on your whole account, right? You can always live to fight another day. So if the market is below the break-even point and your loss equals the initial buying power requirement, then you need to cut loss, right? There is no leeway to this. Once you see the loss hit on your position, you need to be disciplined enough to get out of that position. Now, what if the max loss has not been hit? In fact, for you to actually hit the max loss of this 6,651 is really pretty rare, right? This is almost about something like a 2 standard deviation move, which happens roughly 5% or less than 5% of the time. But of course, there will be times like, for example, the pandemic comes, then you could be in a risk of actually hitting this loss. But for the most part, you're not going to experience this number. So what do you do if the max loss has not been hit? So this comes down to whether it's past the 21 days or not, right? The 21 DTE mark. So this is an important milestone. So I also mentioned this in the other two videos in terms of managing your losing iron condor and managing your losing credit spread. So the main reason why we want to manage this at 21 days to expiration mark as the milestone to see whether we do something or not. Well, first of all, it's because the chances of getting a sign on your in the money short put increases, right? As long as your put option is in the money, then there's always a chance for the buyer of the put option to exercise it. And if he exercises the option, you will be assigned 100 shares at $382, which means to say you need to put up $38,200 to long the 100 shares. And if you do not have the amount, then guess what? The broker could put you into a margin call where you need to either put up more funds or they may liquidate your position for a loss, right? So this is one thing that you want to avoid, and the way you can avoid this is by not letting this option trade go past the 21 days to expiration mark. Because the time when the buyer is most likely to exercise their option is when the extrinsic value is very little, right? Extrinsic value is very little when the option is deep in the money. That's where the intrinsic value will be very high, but the extrinsic value will be low. And when there's very little time left, right, in the option, right? That means it's very close to expiration. That's also the time when there's going to be very little extrinsic value, because when the option reaches expiration, all extrinsic value will go to zero. So this is what you need to take note of. So by managing the 21 days to expiration mark, you will ensure that there is sufficient extrinsic value that the put option buyer will not want to exercise. Now, the next reason why we want to only manage once it's past 21 days to expiration mark is because it reduces your P&L volatility and the chances of the max loss. So most of the biggest losses tend to happen when the option is near the expiration date. And that's because the gamma will start to really pick up, right? When gamma one of the option delta, starts to really pick up, then what happens is that your pricing, the option pricing, becomes very sensitive to the underlying move, right? When before, if the underlying move, let's say for example, if it moves $1, maybe your option price may only move by around 20 to 30 cents. But if the gamma becomes so big, then guess what? $1 move in the underlying stock could result in maybe a 60 cents move, a 70 cents move. So this way, your whole idea of getting to a short position, right, selling premium, is to let theta work for you. But when the gamma gets so big and the pricing gets so volatile, then guess what? Your theta can be overwritten, right? It's being override by the movement in the underlying stock. So you can also see that in terms of average performance, when you manage at 21 days to expiration, it's actually much better, right? So although the win ratio is slightly lesser than if you hold to expiration, but your return, as you can see, is actually higher than if you hold to expiration. And the reason is because you actually control this number, which is the largest loss, because a big loss like this can really take out a lot of the winners which you have. So when you manage it at 21 days to expiration, you eliminate the big losses that comes with holding all the way to expiration. So you can see down here, this is done by the Tasty Trade team. You can see that they've done a lot of studies and in-depth research into this. Then you can see that if you manage your trade at 21 days to expiration, it's much more superior than you would hold to expiration, right? So that is why we also want to manage it early. So the other thing we also want to take note of is the risk profile at 21 days to expiration. You see, it is possible that at the 21 DTE mark, you can actually almost reach full profit of this short option, right? So let's say, for example, this is the price which you started off when you first put on the short put. Now, the market does not have to really move a lot in order for you to reach almost full profit. Let's say, for example, if it just moves $5 to 400, the $400 mark down here, you will see that actually you have already made roughly about 3/4 about the profit, right? About the max profit, roughly 3/4 of the max profit. So there's no need for you to hold even an additional 21 days and then you risk losing all this money. If you see, if it goes all the way to 410 even, you're pretty much almost at the max profit already. The other thing is that if you notice, this purple line will start to become even more and more steeper as time passes, right? As it gets close to expiration. So that means to say, for each day you're holding on to this position, a small move in the underlying stock can really have a big swing in your P&L, right? So let's say, for example, if it goes up, right, just a little small move, you'll be able to make quite a bit in terms of profit. But at the same time, if it moves against you, then guess what? You're going to lose a lot more as well. So at this point of time, it comes down to a lot of luck in terms of where the direction will go to, instead of letting time decay work in your favor. So if the max loss is not hit and there's still more than 21 days to expiration left, then guess what? There is nothing to do, right? The market can come down. You just want to give it time, because it could come back up again. And if it does come back up, then there really is no need for you to have aggressively manage this, right? It could still be in a profit just as it is. Remember, this is a probability game, right? When you put on a short put, let's say for example you put on a 30 delta short put, then there is roughly a 70% chance of profit, right? So you just need to let the numbers play out. Now, if the max loss is not hit, but there's less than 21 days to expiration left, then this is where you need to do something, right? So there are three options that you can take. So the first option is to simply take a loss, right? You can always take a loss and then find another setup again and then enter into a trade. And this is the approach that I like the most. And the reason is because I have many trades going on at one time, right? If you have watched many of my other videos, you notice that I do not trade too many underlyings at one time. And I like to have many positions on the single underlying. So in this case, let's say for example, I have an index ETF like the IWM or the Spiders. I'll have many positions on. I'll have like the Iron Condor, the Strangles, the put spread, the bear call spread, short put, this kind of trades on many at one time. So I do not really want to manage every single trade, right? Because if you have many trades and then you want to manage every single one, it can get a little bit confusing. Rather, you can just let the probabilities play out, because if you just leave it as it is and just take loss over the long run, it will still be in a profit, right? As long as you stick to the proper mechanics to place on the trade. So even though you take a loss, it's not going to be a big setback to this whole strategy, because remember, this is a 70% win rate kind of strategy. If you put on the 30 delta short put, that means to say there's still a chance to lose 30%, right? So when there's this loss, right, you just want to take it, rather than if you choose to do something, let's say for example you decide to roll it down, then there's a chance to further aggravate those losses, because if the market still continues to crash, let's say for example like the SVB situation, the Silicon Valley Bank, then you're going to actually lose much more than compared to if you have just taken the loss initially, right? So this is the first option and the simplest one. Now, the second option would be to roll it out, right? So if you still have a bullish take on this and you think that the market can rebound, you think that the market is pretty oversold, then you can choose to roll out, right? So when you're rolling out, you are actually getting more credit again, and when you have more credit, it helps to buffer to the downside in case the market continues to move lower. But at the same time, if the market does come back up, then you're going to make a little bit more as well, because each time when you roll, you're going to receive credit. And the good thing with short put is that most of the time, even though it is in the money, you still can roll for a credit, right? So if you're not very sure on how to roll short puts, I actually have a whole video on rolling short puts. It's called Rolling Short Puts Masterclass. You can go to my channel and watch that video if you haven't watched that already. So this is option 2. And the third option, last but not least, is rolling out and down, right? So rolling out means to roll out to the next expiration date, to the further expiration date, and you also roll it down as well. So this way you give more room for yourself to be right. So let's say for example from 380, let's say you're able to roll the put option down to 375, then guess what? You've also pushed your break even down as well. So if your break even is lower, then you will have a higher chance for this trade to work out as well, because in the long term, stocks and index ETFs, in this case, do want to go up, right? Of course, if you choose the right index ETF and the right stocks, they have good fundamentals, right? In the long term, they do eventually want to go up. So if you were to just keep rolling it, rolling out and down each time, eventually there will be a time whereby your whole position can be taken out for a profit. So let's just have a very quick summary of what we just went through. So first things first, if the market has not breached your short put strike or your break even, depending on which one you choose, then there's nothing to do. Right? Next thing is, if it has breached your put option or your break even point and it has reached your maximum loss, then you need to cut loss, right? There's no point for you to try and wait and see, because it could get even worse. So the best is to take your loss, move on to the next trade. Now, if the max loss has not been hit and there's still more than 21 days to expiration, again, there's nothing to do, because there is always a chance for the trade to come up. So you just need to give it time, give it room for it to work out. Now, if the max loss has not been hit, but there's less than 21 days to expiration, then there are 3 options to take. Either you can take loss, you can roll it out, or you can roll out and down. Right, when we start off with a short strangle, right, a neutral short strangle, generally we want to start off with the 16 delta, right? So basically this is how we enter into a short strangle, and basically 16 deltas on both sides is the expected move, right? So I've already created a video on the expected move. If you haven't watched that, just go ahead and find that on my channel. And if you're a little bit more aggressive, you can go for a little bit higher delta, maybe up to 20 or even 25 delta. Now, when it comes to rolling, I personally have a few golden rules that I follow, right? So I have 3 golden rules when it comes to rolling short strangles. Now, these are my personal rules. You can choose to follow them if you want to. If you don't want, that's fine as well. So the very first rule is that I only roll the untested side. So what do I mean by untested side? So let's say, for example, if the market goes down, right? So the put side right now is the tested side. So the untested side would be the short call. So I will only be looking to roll the short call down instead of, rolling the short put. Okay, and the reason I do that is that if you were to roll the short put down, most of the time it's going to be for a debit, right? Even though you try and roll the call down as well and you roll the put down, chances are it's going to be for a debit, because rolling down the put is going to be more expensive than the credit you're going to receive for rolling the short call. So that is why I only choose to roll the untested side. Now, rule number 2 is that I do not roll out in time, but rather I just close around 21 DTE, regardless if it's a profit or loss. So what do I mean by I do not roll out in time? So some people, let's say for example, if the market goes down here, they may choose to not only just roll down here, right? You roll your short call down, but they also choose to roll out in time for both the strikes, right? So maybe at this point in time, maybe they have about, I don't know, 25 DTE left, right? Let's just say there's about 25 DTE left. And what they will do is that they will roll down at the same time, they will roll out as well. So maybe they roll out to the next 45 DTE. And for the bottom one as well, they will also roll this to 45 DTE. So like this, overall, you actually get much more credit than if you were to just, roll down by itself. So the reason I do not actually do this is because when you roll out to a further time, yes, you get more credit, but it's essentially the same as just you're putting on a new position altogether. But this time when you put on a new position, right, what happens is that you will start off with a much smaller strangle, right? So your new strangle will now be, you still retain this strike, but now your profit zone is much smaller. And that's the reason why I do not really like to roll out in time. But it's definitely fine if you like to roll out in time. Now, you like to hold on to the trade slightly longer for it to work out. My personal preference is that I would just close out if it's a profit or a loss regardless, right, at around 21 DTE, and I'll wait for the next opportunity again before I open up another trade. Now, rule number 3 is that I do not become inverted, right? So the maximum would be to roll into a straddle. So what I mean by I do not want to become inverted, right? Inversion basically just means that you will keep rolling one of the strikes until it goes below or above another strike, right? Let's say, for example, if the market keeps going down this way, and over time, you can just keep rolling your call, right? Maybe your call will be down here. And then as the market further goes down again, this is where you can keep rolling your call until the point where your call option can even be below your put option. So this is what you call an inversion, an inverted strangle. And this is something that the Tasty Trade folks, they talk quite a bit about. And the reason I don't like to do this inversion because, it gets a little bit complicated when it comes to the calculation. So I like to keep things simple. I like to keep things very neat. And if you do not like to, feel confused, you do not like to see that there's this inversion and, you're not sure what to do, then you do not want to become inverted as well. But for those of you who are very, very, sophisticated and you're very sharp, you know exactly what you're doing, then yeah, there's nothing wrong with going inverted as long as you know exactly how to uninvert it, right, when you want to get out of this inversion. Okay, so with these 3 golden rules in mind, let's get into rolling. So how do we actually roll the short strangle? So there are 3 methods that I'm going to share with you. So the first method is to roll based on delta. So what do I mean by this? So what it means is basically to roll the side where the delta has dropped to below a certain number. So remember, we start off at 16 delta. So if either side actually drops below 10 delta, then that's the one where we'll consider rolling it, right? So for example, let's say the market goes down and now the short call is at 8 delta, right? So if the market goes down, basically your put side, your short put will pick up delta, right? Basically it will increase, and on your call side, it will drop in terms of delta. So at this point, this is where you can consider to roll down your short call, as this is what I call the untested side. Now, theoretically or technically, this short put has not been tested, right? But it's getting close to being tested because the market is going down. So I will just consider the call side down here, the untested side, right? Similarly, if the market goes up, then the put side will be considered the untested side. All right, so this is where you will consider rolling your untested side. So in this case, it will be the short call. So the question now is, what delta do you roll it to? All right, so there are 2 options for this. The very first option is that you can simply just roll back to the initial delta. So what you want to do is you just find the option that has 16 delta and you roll to that one, right? So if you started off with a 20 delta, then you could just choose to roll to the 20 delta. Or if you're a little bit more conservative, you could just choose 16 delta or 15 delta, right? Now, the second option is that you could roll it to a slightly higher delta, right? So if you start off with 16 delta, maybe you might want to roll it to 25 deltas or even 30 deltas, right? So basically it's above 16 delta, and this basically is when you are a little bit more bearish on the underlying, right? You think that the market is still going to continue going further down, then you could choose to be a little bit aggressive in the rolling of your delta. But do keep in mind that, the more aggressive you are when you roll to a higher delta, although you will get a higher credit, there is also a higher chance that you could be whipsawed, right? Because the market could go down and then all of a sudden the market could reverse back up. And because you have rolled to a higher delta, right now your short call strike down here is going to be much closer to where the market is. So this is one thing to keep in mind. But of course, if the market, doesn't go up and it continues going down, then rolling to 30 delta, right, would be the better move because you actually collect more credit. So it actually helps to reduce your overall risk. Now, the next question is, what do you do if the market actually does go up, right? So let me just remove this drawing. What happens is after you have rolled down and then the market all of a sudden bounces back up and now it tests your call side right now. So same thing again, you would also still roll based on delta. So at this point in time, you can see it's at 35 delta when the market is at this point. Now, when the market goes up, now this delta will definitely drop. So the question is, what is the point in time where you choose to roll this put strike up? So this ultimately comes down to your personal preference, right? You could wait until the delta actually drops below 16 delta, then you can start to roll this put option up. Or you could choose to wait until it drops to a single digit delta, let's say maybe 10 delta, then you roll it up. Again, there's no right or wrong answer here. It really comes down to how aggressive you are in wanting to, actively manage your strangle, your disposition. Okay, so keep in mind again, the more active, the more aggressive you are, the more you can end up over managing your disposition. Now, the next method is to roll when the short strike is breached. So what that means is to roll the untested side only when either the short call or short put has been breached, right? So if the short call has been breached down here, then you'll be rolling the put side. Right. On the other hand, if the short put has been breached, then you'll be rolling your short call down as well. So the short call on this hand would be considered the untested side. So let's say, for example, let's say the market has gone above your short call strike. So this is where you can consider to roll up your short put. So again, which delta do you roll it to? So at this point in time, when the market has already reached the short call strike, it's roughly around 50 deltas, right? So this is where, this is considered at the money options. So your short put most likely will be in the single digit, right? If you start off with something around 16 delta, because the market has really moved quite a bit already. So again, it's the same two options, right? You can either roll to the initial delta, 16 delta, or if you're a little bit more aggressive and you think the market, is going to continue going up. If you think the market is going to continue going up, you're very bullish on it, then you can choose to roll to a higher delta, right? Anything above 16, okay? Now, here's the question. What if after you have rolled the put option up, the market still continues to go up, right? So at this point in time, your strike has already been breached. So do you still roll up this put option down here? So this again comes down to your own personal preference. If you're just a little bit more conservative, right? You're afraid that, the market might come back down and you do not want to get whipsawed, then you can just choose to stop your rolling there. Alternatively, if you want to still continue to manage this position, then this is where you would now go back to method one, right? Method one, basically just see this delta only. If this delta has dropped to a single digit, then you roll it up again to re-establish the initial delta again, right? So let's say, for example, this delta down here has dropped to somewhere around, say, 8 delta, right? If it has reached around 8 delta, then at that point, you can choose to roll up to the next 16 delta again. Then you can keep doing this until roughly around 21 DTE. Then that's where you would choose to get out of the position if you want to, right? Again, this is one of my mandates. I will generally get out of any undefined risk strategy, especially undefined risk strategies at around 21 DTE, because past that, the gamma will start to pick up. It's going to be much more risky for any undefined risk strategies that you have. All right, so method number three. So method number three is the most conservative one. So you roll only when your break even is breached. So
for every strategy that you put on, there's always a break-even point. So for the strangle, the break-even point is past your short strikes, right? And the way you generally calculate the break-even is you take the credit and then you add up, subtract to your short strikes, right? Depending, is it the short call or the short put. So let's say, for example, you receive a credit of $2.50 for this strangle, right? So what you want to do is, for the call side, what you're going to do is just going to add this credit to your short strike. So if your short strike is at, let's say, 193, then you add on $2.50, then that's where your break even is, right? Your break even is going to be at 195.5, and on the put side, you just subtract it, right? So if it's at 173, then you subtract $2.50. So this is where your break even point is. So this means is that you only roll the untested side when the break even on either side has been breached. So this is an even more conservative approach compared to method 2. So this way, you're actually, much more passive in terms of your rolling. Now, if you're not sure how to calculate the break-even price, even after what I just shared with you, then there is a simpler way, is that you can just simply go to your, the payoff diagram or the P&L graph on your broker's platform, right? So for this is TD Ameritrade. Basically, you can just go to the graph and they'll tell you exactly where the break-even price is. So as you can see down here, the red lines on the left-hand side and the red line down here on the right-hand side, these are where your break-even price is, and you can just simply take it and then mark it on your chart. So you know exactly when the market has breached your break-even prices, right? So you can see down here, this is where your short put is. This is where your short call is. So this is a very quick way and easy way for you to see when your break even has been breached. All right, so for example, let's say the market has gone above your short call strike and it has breached the break even point above your short call strike. Then this is where you can consider to roll up your short put. So which delta do you roll it to? So again, you should know by now, it's the same two options, right? The first option, right, you can roll it just to the initial delta. And option 2, you can roll it to a higher delta. Now, the question is right now, what if the market continues going up? Well, in this case, then again, the same thing, we default back to method 1, whereby we just look at this delta, right? So if the delta drops below a certain number, right, this number is basically up to you based on how actively you want to manage it. Right, once it goes below this number, then you can start to consider rolling your short put up again, or your short call down if the market, tests the put side. Okay, so now that I've shared these 3 methods with you, you might be wondering, hey Davis, which method should I go for, right? So which method is most suitable for you? Well, the answer really comes down to your trading style, right? So it depends on your trading style and how often you're able to monitor the market. So if you have lots of time to stare at the market and you like to actively and aggressively manage your positions, then go for method 1, right? You can actively reduce your risk as you manage your deltas of your short strangle, but also do keep in mind that the more actively you manage your positions, the more actively you roll it, then there's a higher chance of a whipsaw as well. So again, there's no one that is best, rather it's just a trade-off. Now, on the other hand, if you don't have much time to watch the markets, or you like a more passive approach to managing your positions, then go for method 3. So basically, method 3 is the most conservative, the most passive of all, because it takes quite some time before your break even is breached, and in many cases, it might not even breach your break even. So a lot of the time you could end up, not even rolling your trades at all. And you find that, your strangle is just going to work out in the end. So if you're a little bit more passive, or maybe you have a full-time job that you're not able to monitor the markets, or maybe you're, new to trading it and you do not want to get confused or overwhelmed by, having to actively manage your positions, then go for method number 3. And if you like a good balance of both, then go for method 2, where you only roll when your short strike is breached. And this way is also pretty simple for you to just look at the charts, because you already know where your short strike is, and you don't also have to worry about calculating where your break even is. All right guys, so this is how you roll short strangles, and I hope this video has been helpful for you, and if it has, please give me a thumbs up.